A central bank meeting and a number of company reports mean we have a busy week ahead of us. The central bank in question is the US Federal Reserve, which will declare its latest monetary policy decisions on Wednesday the 10th of June. Remember that during the COVID-19 outbreak, America's central bank has cut interest rates from 1.75% to 0.25% and relaunched its bond buying quantitative easing or QE scheme, increasing both the size and the scope of the instruments it can buy. The Fed's balance sheet has swollen from just over $4 trillion to just over $7 trillion in the space of barely 2.5 months. So if you're looking for any reason as to why US stocks are performing so well, this could be as good an explanation as any. Cheap Fed-supplied liquidity looking for a home. The benchmark S&P 500 index bottomed in late March once the Fed had turned on the taps, and it's barely looked back since, sweeping aside the lockdown, race riots and a resumption of trade tensions with China as if they don't matter. They clearly do matter, but for financial markets, money talks, and right now, the Fed is providing dollops of it. Liquidity is king. The S&P 500 is 8% higher than it was a year ago. Can we really say that things are 8% better than they were at this time of last year? Can we say for sure that things will be 8% better at this time next year? That's something that only you can really decide. But analysts and economists will be studying the statement from Chair Jay Powell on the central bank's future plans for both interest rates and QE. Any move to take away that cheap cash seems as unlikely as it would be unpopular, at least for now, as the US economy tries to clamber out of the deepest and sharpest recession in its history. Back on the domestic front, there's a fairly lengthy list of full-year and half-year results and trading statements scheduled, and we may get some unscheduled comments too, though do please remember that the Financial Conduct Authority is still giving companies extra time in which to prepare their accounts, so these dates are all just a little bit provisional. Names which may be worthy of note include engineering software specialist Aveva, British American Tobacco and cybersecurity expert GB Group on Tuesday the 9th of June, real estate investment trust Shaftesbury and London Metric Property on the 10th, TalkTalk Support Services Group Babcock and B&M European Value Retail on the 11th, and then Brewer to Pubs Group Marston's on Friday the 12th. But for me, the company most capable of causing a fuss in the week ahead is Johnson Matthey. The FTSE 100 firm is due to report its delayed full-year results on the 11th of June. The chemicals company shares have dropped by a third over the past year, twice as fast a decline as the broader FTSE 100 over the same period, although having said that, they are up by almost a quarter from their April low. Now, Johnson Matthey's got 4 divisions: Clean Air, Efficient Natural Resources, Health and New Markets. In terms of sales and profit, Clean Air, the unit that provides catalytic converters to cut automotive emissions, is still the dominant area. The New Markets business, which analysts say has got the highest growth potential, thanks to its plans to attack the market for batteries for electric cars, that's still tiny by comparison and was actually in loss at the first half stage. That New Markets operations focus on the development of an enhanced lithium nickel oxide cathode material, or ENLO, for the electric car market, but it is still early days. A factory in Poland for ENLO production is due to come on stream in 2022, with commercial platform shipments starting in 2024. Analysts and shareholders will be looking at the performance trends of all 4 units when the full-year figures come out, especially at Clean Air, which had suffered what management called cost inefficiencies in the first half, which it had been hoping to iron out in the second. However, the world's changed a lot since last September when those first half figures came out, and Johnson Matthey released a statement in late March as it began to digest the impact of COVID-19 upon its operations. The company noted it would take a £50 million profit hit from COVID-19, presumably right at the end of its year that ended in March, thanks to a lower demand for cars, and therefore at its Clean Air unit, and also including a 20 million supply chain disruption hit. Now, the Chinese facilities that the company has, they've begun to ramp up again in late March, and global car makers have also started to resume output, so there is some good news. Most of the catalytic converter plants were still running at the end of the year too, but Health was suffering from shipment delays owing to border controls, and the precious metal refining business was operating at a lower capacity than normal as the year ended. As a result, analysts have cut their underlying pre-tax profit forecast for the year that ended in March to £466 million. That compares to £523 million a year ago. Attention will then switch to the dividend, where Johnson Matthey has so far maintained a studious and dignified silence, even as 46 FTSE 100 firms have cut deferred, cancelled or suspended payments, and 32 more have confirmed them at the time of recording. Johnson Matthey has grown its annual dividend every year since 1987, according to figures from Refinitiv, and it increased its first half payment by 5% despite that interim slip in profits. However, the proud dividend record could, in theory, be in jeopardy. Analysts have penciled in a full-year dividend of 68.3p a share, down from 85.5p last year. That implies a second-half distribution of 43.8p, a cut from 62.25p last year. If that figure is right, Johnson Matthey would be offering a historic yield of some 3.2% as of the time of recording. It's unlikely that management will feel able to offer any guidance for fiscal 2021 given the current uncertainty, but the consensus forecasts are currently looking for a 15% drop in underlying pre-tax profit to £394 million and an 8% cut in the dividend to 63p a share. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.